All right, everybody. Welcome to Crescat's market call featuring our macro and activist mining research. Before we get started, please refer to our important disclosures page on the screen now. And these can be also found in the description of the Crescat's YouTube channel or also in our website. Crescat's live market call is about sharing timely macro and newsworthy geologic updates, both positive and negative news across our holdings as they arise. These videos represent the opinions of Crescat as the mining and exploration industry advocate. Our objective is to share the overall geologic progress of our activist strategy in creating new economic metal deposits in viable mining jurisdictions around the world. The securities discussed herein do not represent an entire portfolio and in the aggregate may only represent a small percentage of a strategy's holdings. The issuers discussed may or may not be held in Crescat's clients' portfolios at any given time. This video is not intended to be, nor should be constructed as an offer or to sell a solicitation of an offer to buy any security. If you enjoy our videos, please click on the like button and make sure you're subscribed on our YouTube channel and get notified of our upcoming episodes. You can also follow Crescat on Twitter for ongoing macro research and important news updates on our activist metals positions. If you want to learn more about Crescat and our strategies, we encourage you to reach out to Marek Iwahashi. His contact information is on the screen, and you can also be found in the website at Crescat too. So today, this video will be recorded it's being recorded on a Wednesday. As you probably know already from the prior video, we've been recording these videos rather than doing them live. Today I'm going to be the only one actually presenting. So just so you know that Quentin or Kevin will not be presenting on this presentation again. So let's get started with my side of the presentation. Actually, we wrote a letter recently. A lot of the content in this presentation will be regarding that letter and what that was about. And it was mostly about the fiscal mess, in our view, that is in the US and other places globally, but also explaining what we view as opportunity overall as far as our own views in the macro side. And the slide to start here is perhaps one of the most important things going on right now is this strike that we're seeing, labor strike. To me, this is sort of in the foundation of inflationary regimes. If you study in history, especially in the 1970s, labor strikes are quite common at those times. And the main reason for that is because, cost of living rises, and then you have folks demanding higher wages and salaries. And ultimately, it starts driving as well the social unrest and the need for most of those folks to start protesting and wanting to get higher wages and salaries. And this is no different. I don't know. I think a lot of folks have been saying this is going to be as bad as the COVID situation from a logistics standpoint and the surging prices. I don't know if I agree with that view necessarily. I think the world is very different in the pre-pandemic era. And one of the main reasons for that is that businesses have high amounts of inventories. But nonetheless, I wouldn't say either that this is not an inflationary potential to the economy. I do think that this could be something that can drive prices of consumers and goods and services significantly higher. And so it's something to be aware of. It's something to consider, especially in the macro setting that we have. Let's go to the next chart. Now, this is the leading chart of our research letter. It's looking at non-growth fiscal spending percentage. This chart is basically showing, a calculation is really just seeing how much of the fiscal stimulus is really coming from pro-growth investing versus what we think it's not a very productive spending that creates growth necessarily. 55% of this fiscal spending today is non-growth, supposedly. And what is non-growth? Non-growth is net interest payments, one of them, plus the entitlement stuff. So Social Security, Medicare, veteran benefits and services, all these things are being accounted to close to 55% of fiscal spending. So you have to think about one of the I believe that one of the research that we did actually 2 letters ago was really predicated on this idea that what really created growth in the US versus other places in the world, and why we have, in our view, inflated valuations versus other places in the world, particularly either developed economies or emerging markets, especially, is because the US has the reserve currency status, and the reserve currency status really allows the US to take a less disciplinary approach and have, be more reckless on the fiscal spending side. And so because of that, we've seen more growth. And we haven't, as you can see in this chart, this surge that we've had is something more recent. It's going back to 40 years of research. We haven't seen anything like we're seeing currently. So my view, the government has really 2 options. I mean, maybe there's more options, but in our analysis, there's really 2 things that I think that are very important that the government could be doing to adjust this issue. Number 1 is to suppress interest rates. Suppressing interest rates would basically cause the net interest payment aspect of this calculation to be suppressed. That's one thing. The second thing is to just increase spending. If they increase spending, by definition, despite the fact that 55%, you would actually shrink the 55% because the additional spending would supposedly come from pro-growth fiscal expenditures, and that would actually generate growth as well. So those 2 options they issue are highly inflationary when you think about it, at least in our view. And so this is something that it's going to add, in our opinion, to the inflation picture in a quite significant way. So it's something to think about, and none of these things in the macro world are certain. So keep that in mind. But fiscal spending is something that certainly is highly linked to creating inflation over time. So when we see this situation, this sort of dilemma that the government is facing, in our view, that could be highly inflationary as well. Let's go to the next chart. So now there's another phenomenon that I put out recently that been around now. It's the global money supply. Global money supply back after the pandemic crisis, most countries went on to expand the monetary base of their currencies and increase credit in order to stimulate their growth of their economy. As you can see today, it's almost like we're seeing a second wave of global money supply. Now, I don't know if we're going to get to the same levels we saw, in this chart showing over $15 trillion of growth in global money supply. And today we're half of that. We're about $7 trillion. But it's also not to be ignored. It's something significant. And just to be blunt here, we haven't even seen what most have been talking about, which is the bazooka from China, still, really driving money supply much higher. So I would think that this can have also inflationary implications. But why? Let's go to the next chart. Go to the next chart here. You can see global money supply versus CPI. Well, the correlation, I think, it's undeniable. So when people used to say, well, money printing creates inflation, while money printing is a term that it's not necessarily true, because the technicality of how the expansion of the monetary base works doesn't necessarily it is money printing per se, but it's close enough. And so just saying that the dilution of capital, dilution of money itself through the increase of money supply historically has created some large increases in inflation, as well, as you can see by the CPI here in this chart. Let's go to the next chart. So we think that that's going to drive inflation as well. So let's develop more on that thesis, because there's something else going on that I think it's highly inflationary, is what's happening with agricultural commodities. Agricultural commodities have been leading overall commodities themselves. As you can see here, they are in white, measured by the equal weighted commodity sector by the Goldman Sachs index. And then the red line is looking at the DBA ETF, which is just an agricultural ETF that measures, or I should say, has positions and holdings in different agricultural commodities. And as you can see here, and some of those very highly concentrated in cocoa and some others, but nonetheless, you can see clearly that the red line and the white line do have a connection. Makes sense. right? I mean, if agricultural commodities are rising, would expect other commodities to also have some sort of link, particularly knowing that these commodities work on through a kind of rotational process or dynamic in which, when one commodity tends to rise, it tends to drive others. And it's interesting when you are most of the times you are in an inflationary era, you can kind of see, or I should say, in a commodity cycle, one of the things that tends to be a normal phenomenon is that you tend to rotate into commodities. You see like the surge we saw in prices back in 2021 with lumber prices, and then after that we saw natural gas. Those two commodities are not related per se, and then natural gas spikes, and then ammonia prices spike, and then later on you see energy prices again, oil going up significantly in 2022. Then orange juice. What does oil have to do with orange juice? And you start seeing that all these commodities kind of rotate. Recently was gold, not too long ago. And then what was the flavor of the day? 3 months ago, that was copper. And so you can kind of see how these commodities kind of rotate. And this is what's happening now with agricultural commodities. They're the ones that have been sort of consolidated for some time now, and now it's started to move. So my opinion in that this dynamic is perhaps evident, but also clearly could be the main driver for other commodities to follow agricultural commodities. Again, this is not certainty. That's not how you look at things. You kind of have the puzzle here, and you're just putting things together and seeing money supply growth, seeing fiscal spending, the situation when the Fed is having to cut rates and so forth. And now you're seeing as well overall commodities lagging agricultural commodities that started to have a big move, labor strikes, all these things we're going to add to the inflation picture in a big way in our view. Let's go to the next chart. Now, in the next chart, you're looking at financial conditions. This is measured in many different ways. In this case, I'm looking at the Goldman Sachs Financial Index, and I believe it's incorporating different things: the Fed funds rate, the 10-year yield, the credit spreads, equity performance, equity valuation, a dollar basket as well versus other currencies. So all these things are adding into what the financial conditions of a country should look like, in the US in this case. And you can see that things are pretty loose. In other words, they're not tight, and money is flowing quickly here in the economy. And so what does that mean? Well, when you also taking interest rates lower, which is part of the condition, monetary or financial conditions in this case, but when you take interest rates lower already in an environment that we are in that is very loose, the loosest in 2 years, you should be noted, because it only adds to this dilution of capital, dilution of money, and inflation impact in the economy as well. So, and it's something that I've been very concerned about the US dollar, because doing what the Fed has been doing and being forced to do that, mostly in our view, because of how high interest payments are relative to GDP, is something to be aware of. So anyways, let's go to the next chart. Now, in this chart, you've seen some of these. And by the way, the dollar recently has got a little bit of an appreciation the last 2 days here. I don't know what it's going to be doing by Friday or when this video gets released. But as you can see in this chart, the Australian dollar stepping back, what is this? Going back to 2010, you can see that we're breaking out from supposedly a historical resistance. And this could be a major breakout if confirmed with more candles on the upside. And so it's something that I am paying very close attention to, because it's part of our thesis is that other fiat currencies may start actually appreciating versus the dollar for many reasons. Some of what I just said about the interest payment relative to GDP, but also resource-rich economies like Australia benefiting from commodity prices moving higher potentially could also drive growth and drive their currencies to strengthen versus the U.S. dollar. So it's something I believe that certainly requires more attention, because these currency trends, when they really develop themselves, they tend to unfold in for years, sometimes decades. Early 2000s was a great example where we saw one of those trends that went from basically the early 2000s. Right before the tech bust, all the way to 2011. And that drives a lot of things. It's not just a currency trend. It tends to drive emerging market companies as well. Let's go to the next chart. And then this next chart kind of presents that idea. you can kind of see the Latin America index versus US equities are one of the cheapest levels we've seen throughout history. And so you can see here, in this case, I'm using the MSCI USA index versus the MSCI Emerging Markets Latin America index. And you can see that the price differential between the two. So when this ratio is rising on the first panel, it means that Latin America companies are outperforming US equities. And you can see we had that trend happening in early, actually 99 all the way up to 2011. If I use the S&P 500 rather than the MSCI USA, which are basically the same thing, but as a ratio, the Latin America index actually, MSCI Latin America index went up, close to 700% relative to the S&P 500. That was a time, as presented in the second panel of this chart, where we look at the valuation differential. So it's basically taking what's the aggregate free cash flow yield for Latin America companies versus what's the free cash flow yield for US equities. And you can see the spread is close to 6% today. So you get 6% yield more than US equities today. It doesn't sound shocking given the fact that, the panel above shows the underperformance of Latin America companies. But, doesn't mean that it's historically cheap right now. In our view, that's the case here. So I think that this is an interesting place for us to find exposure in a world where valuations, in our view, especially in the US, are so inflated currently, particularly in the technology industry. But anyways, the point of this chart is to show that we go through cycles, right? There was a cycle back in the early 2000s where Latin America companies actually outperform US equities. That seems to be unimaginable today. And these things, they can happen, and they're not impossible. And so this is something that when prices are not reflecting, or valuations are not reflecting the probability or the possibility of that outcome happening, that asymmetry starts to become quite attractive from a value investor standpoint. So this is our value investing approach 101 being presented in this chart. Let's go to the next one. So in the next one now, it's back to hard assets, because one side of this fiat currencies versus the dollar appreciating thesis also, I guess, is most of the times involved with other trends like tangible assets doing very well. And I believe that, as you can see in this chart, we're looking at silver. Remember that rotation that I was talking about? Well, if you ask my opinion, I think that silver could be part of this rotation here in the following in the coming years. And I do think that the case for this is supply side is extremely constrained. We know that new mines coming online for the silver space have been very challenging. Space for creating new mines and finding new supply of silver. But not only that, capital has been very constrained. We know that that tends to have a lag on the cycles for mining. So, when capital gets limited in a certain industry, particularly resource industries, that tends to create a bottleneck for supply in the future. And so knowing that we have that situation now helps us guide of what supply will look like, 5-7 years from now. And remember, it takes about 15 years in average to build a mine. From scratch, meaning from owning a property to actually having a producing asset. 80% of the time that takes is mostly on exploration, and then the other time is to actually develop the mine, the engineering process behind that. And so keeping that in mind, and then seeing India, which is a country that, in my view, is, from a consumer behavior standpoint, has a different way of looking at precious metals in particular. That economy, yes, they see as jewelry, as important, but also as a way of protecting their wealth versus the monetary dilution that we tend to see worldwide. And India is definitely one of those countries. Asia in general has that cultural aspect, but it's important to see that Indian imports is making record levels of silver. And keep in mind, this is in dollar terms. So if you go back to 2011, for instance, silver prices are much higher than what they are now, which means that the volume that they're purchasing is actually drastically higher than it was back in 2011, the prior peak for silver. So this is quite an important chart, in my opinion. It goes to show potentially how their households are really thinking about how to protect their wealth in a big way. And so I think this is quite relevant chart, adding to the demand side of the picture for silver. Let's go to the next chart. And silver recently made highest levels in 11 years. A lot of people have been very frustrated by the metal. The metal had a really good year in 2020, then basically went sideways for 3 years, and now recently have been making a move again. And in my view, from watching commodities and studying commodities for a long time, you will see in many charts, gold, copper, silver, that they tend to go through those spikes and then consolidation, big spike, consolidation. And in my view, we're kind of in a process of that a big upward movement in silver prices as well. Now, being at an 11-year highs, you have to think about what is that doing to the fundamentals of miners that actually produce silver itself. And if we go to the next chart, in this chart now we're looking at the leverage that tends to be in that case. So yes, you leverage works both ways, right? On the negative side and a positive side. If you're long the miners and when metals are going up, that leverage can play in your favor. When you're long the miners when metal prices are going lower, that leverage will definitely play against you as well. And so that volatility profile gives higher risk, and therefore markets tend to reward the higher risk profile of a business when the underlying metal price is actually moving higher. And it's interesting because you have here the mining stocks. So there's a significant amount of base metal stocks. That's why I'm using as proxy for metals, industrial metals, mostly copper, zinc, and others in yellow. And you can see that there's been a divergence. We've had a little bit of pullback in industrial metals recently, but the equity side still continues to move higher. And this resilience that we tend to see on riskier parts of the segment of a certain part of the market, in this case commodities, is something that usually is a sign of strength, because investors that are taking more risk are still comfortable staying in that position regardless of the downward movement or weakness that we've had in industrial metals all the way back from 2023. I think it's January 2023 when we start seeing the separation between these two charts. And so this is, in my view, this is remarkable. It's a sign of strength, again, in my opinion. But it's anyways, it's another way of trying to understand where we are in the cycle of this mining industry. Let's go to the next chart. Next chart, we're looking at the supply side of metals. Chile is not quite the OPEC of copper, but it's definitely the Saudi Arabia of copper. It accounts for, Saudi Arabia, I think, accounts for about 6% of production in oil globally. Chile is about 1/3, not quite, but close. So it gives you a sense. I mean, if Chile, is almost 1/3 of global production, and we're seeing the lowest level of production all the way back to 2012 levels, what is this? 12 years of a low in terms of production. It's something that concerns me as from a society standpoint, because I do think that all these trends that we're seeing in terms of AI, electrification, improving the grids, the efficiency of the grids that we have, electrical grids, onshoring, and all those things. It's hard to believe that that's not going to drive the demand for copper, in my opinion. So as we see that occurring, it's scary to see that production has been not responding to higher copper prices. I mean, copper prices are not doing bad. I mean, recently, been in the last 1 or 2 years, even 3 years, copper prices have been doing quite well. You would expect that companies would be producing more. The issue is that if they don't develop mines, they can't expand production. And the mining industry has usually very long cycles because of the dynamic of creating a new mine and how long it takes to bring in new supply. And so this is why you're seeing the chart that you're looking at, where metal prices are much higher, but companies are not being able to actually expand production to the same degree. I'm not picking on Chile only. You can see this globally as well, It's just easier to find data for a single country a lot of times. Therefore, why I'm using this one as an example. But this is a very significant producer of copper, obviously, globally. Not many commodities have a big player like this, like copper does with Chile. Anyways, let's go to the next chart. Now, next chart, we're looking at an interesting relationship. I mean, a lot of people think that, and I'm in that boat too, that silver is the high volatility version of gold, and gold usually, historically, when gold goes up, silver goes up a lot more. When gold goes down, silver declines a lot more. That volatility is just like the metals industry versus metals themselves. That leverage that you tend to take on the risk of operating a business in the space helps you, and it can hurt you. But what is interesting in terms of relationship, as you can see here in this chart, is that gold, when adjusted by CPI or adjusted for inflation, I know some people will hate me to say this because CPI per se is not the best gauge for inflation for most people, and I would include myself in that camp as well. But it's one of the what the government uses for sake of the argument here. But it is interesting for a fact, as you can see in the chart, that gold adjusted by CPI versus silver actually are quite almost like the same chart, and both have this massive cup and handle. Technically speaking, for those who don't know, it's just a technical formation that tends to be bullish. Doesn't mean it will be, but it tends to be bullish. In the technical world, it's called cup and handle, where you see this formation of a big cup and then the little handle after. Most of the investors will be familiar with that term. But in our view, the main point here is that those two lines have not made a new high. And the whole point of a cup and handle is that you tend to see explosive moves and take out the prior highs. And so, this is, if indeed this is correct, a correct read of the technical formation of these two securities per se, then this could be an interesting setup for silver itself. Anyways, let's go to the next chart. In the next chart, I'm showing something that I find it very interesting. It's I always look at predictions. I always look at what are people expecting, because in the forecast, especially by Wall Street analysts, and one of the things I see from most analysts, and this is using Bloomberg's analysts, and they take a median of all the Wall Street analysts and where they think silver would be, in different time horizons. And you can see here, when markets get to that euphoria moment, the term euphoria comes from everybody expecting a lot more, right? And then you get to that craze, frenzy environment where people are expecting some crazy numbers, and it doesn't reach that positive expectation, and therefore ends up being actually a negative surprise. And that's what usually causes the big crashes in different markets. Could be a company, could be a commodity, could be almost anything, could be your reputation, could be anything. And it's interesting that despite the fact that we've had a big move in silver recently, the predictions and the forecasts in the markets have not followed that yet. So, you can look here, there's a inherent 13% decline in silver prices. That's expected silver prices decline by 2027, but the median analysts in Wall Street today. And, our view is obviously different. Our view is we invest in the space because we have a positive outlook for metal prices, but really also because of the high quality that we see in terms of most of those businesses that hold those assets too. And so I find this really interesting. If you do the same with gold, you will see the same kind of issue where the forecast for gold prices is also much lower than the spot price of the metal. Let's go to the next chart. All right, next chart. It's a chart that I looked at the prior presentation as well, and I find this a chart that is important. We're looking at, to begin with, precious metals is an industry, not a sector. But if it was a sector, you would have the best cash flow margins of the entire market. Now, which ones are the precious metals companies that I use for this research? Well, I use both exchanges, US and Canada, and I looked at companies that have over $1 billion in market cap. And you can see here that somebody can come up and say, well, Tavi, you're picking one metric. Yes, I'm picking just one metric. And the point is not just to be, specific with this metric. I think you should look at, or anybody should look at many, many metrics, multiple metrics. It's the reason why we have a model that looks at, the 50 different metrics, but all sorts of combinations of how we measure the value of a company. And other people will do different things as well to value a company. But the point here is that there is an inherently, or overwhelming skepticism towards the industry of mining. And for a lot of people, it'd be shocking to see that this industry is actually making money. And so this is the point of the chart, is to show that fundamentally these companies have been improving in some very important metrics, and this is one of them. And as we see the improvement of metal prices, especially even in some companies relative to other metals, like especially gold versus oil. Think about if a company running an open pit project where energy prices do have a lot of relevance in their costs. All those relative performances that we're seeing for the gold companies and the metals versus other energy commodities as well, I think will add to the profitability of this industry. And in our view, the profitability is tied up to the metal prices, of course. And we think that these companies can continue to look much better. Now, here's in our view, another thing that I should point out is that this is one of those industries that are truly legacy business. I mean, it's been in place for centuries, mining. And one thing that is important to notice is that I always love to find these legacy companies or legacy business models with what I believe to be a secular growth story in the horizon. And this is our view on precious metals and other metals, but especially when you have those multiples that are not really reflecting the opportunity ahead. And to me, that's where I see the opportunity. Let's go to the next chart. I think I'm almost done. There you go. I'm done. All right. Well, look, thanks for watching. I'm sorry I went a little longer just because I'm the only one doing the presentation this time. We're going to be back in 2 weeks. So we're doing this every 2 weeks to make it easier on us as well, because we've got a lot going on. But also so we can keep our audience informed of our views and things that we're working on. Now, if you have questions about Crescat, if you want to know more about our funds and what we've been up to, I would say please speak with Merrick. His information is on the screen. You have his phone number, you have his address, email address. We're always happy to talk to you if you have any questions. Also, we put out a letter recently that I highly suggest you, but I'm biased, but I think you should read. I think it's an important letter with a lot of interesting macro, ideas and thesis about what we believe, is, really about our views in general and how we are investing in the space right now. So thanks everybody for watching. We'll be back next week. If you don't follow us, please follow us on YouTube. But that's it. We'll be back in 2 weeks. Take care.